Hello and welcome to today's webinar from Fidelity International's real estate team, Turning Impact into Opportunity, Why Impact Investing is Beneficial to Value Add Commercial Real Estate. My name is Nina Flitman, and joining me today is Kim Ponitzer, Director of Research for European Real Estate, and Emeric de Sarasan, Portfolio Manager for European Real Estate. Hi both.
Good morning.
Morning.
We have about 30 minutes of your time today. The first half of the session will spend looking at the current state of the commercial real estate markets and also discussing our analysis that demonstrates why impact investing in real estate can not just be a way to have a positive effect on the planet, but can also be beneficial to investors' returns. Now, we know the last 18 months or so have been a tough period for European real estate, but as the storm is now clearing, we believe that market conditions are becoming increasingly favourable for a value-add impact investing approach, and there could be some really interesting opportunities now becoming available. We're going to spend the second half of the meeting today answering your questions. There's a Q&A button at the bottom of your screen, so please be sure to send your questions in during the course of the presentation, and I'll put them to Kim and Emeric in the later section. With that being said, I'll hand over to Kim to begin.
Thank you, Nina. So there are three themes that I want to highlight in talking about why we think that do more in 24 makes sense when thinking about deploying capital into impact strategies in real estate. But at the outset, let's just define what we mean by impact. We're talking about renovating existing buildings, not only to improve the look and feel of the building, but more importantly, to improve things like energy efficiency and to make them operationally net zero carbon. This can be achieved in a number of ways, depending on sector and building. But back to my three themes. Firstly, we've seen repricing over the last 18 months that now provides a very attractive entry point for acquiring buildings. Secondly, occupiers continue to seek buildings with strong green credentials to align with their own ESG commitments. And thirdly, there's a shortage of this space that's operationally net zero carbon, and when combined with strong demand, this continues to drive a considerable green premium. So let's look at each of these in a little bit more detail. Let's start by looking at the scale of repricing. Using prime market data from CBRE, we can see that values have fallen by at least 30% for offices since mid-2022 and are continuing to fall as some investors remain concerned about the cost of renovation and the skill set required to deliver green buildings, but also about the scale of future office requirements as hybrid working disrupts demand and patterns of use. For industrials, values have fallen about 20% from peak, but do appear to have stabilised as falling values have been cushioned by strong rental growth. And this has continued to attract investors. With values still falling, market liquidity remains weak in Europe, and it remains very much a buyer's market. The ability to source deals off market is going to be important in such conditions because sellers are often cautious about being seen to be distressed if they openly market assets. We do believe that the broader real estate market will start to stabilise this year as interest rates come down, so the risk of further near-term losses is fairly modest. But what is clear is that with prices 20 to 40% below their peaks, we do have a very attractive entry point for acquiring assets now. So moving on to my second point, about demand for green offices. We go to the next slide. As companies have developed their own net zero carbon targets, their space requirements are becoming more focused on sustainability characteristics. Just a simple headline figure for London is that 40% of London office leases are for the most energy efficient space. This is rated using our EPC ratings A and B. And that's up from 20% in 2018. Scarcity is also driving occupiers to take longer leases on their space. Buildings in London with the highest energy efficiency rating of A achieve leases that are roughly 3 years longer than those with lower energy efficiency ratings. Looking ahead, while there's an increasing awareness in the market of the requirements for sustainable space and the green premium they can achieve, demand appears to be well ahead of supply. So this chart on the left-hand side is from research by Jones Lang LaSalle last autumn. They looked at the top 100 largest occupiers in major European cities and looked at their future demand for green space. They found that there's about 3.9 million square metres of demand coming up in the next few years. In contrast, when you look at the supply of space that meets these requirements, there's only 1.7 million square metres planned. So there's considerable unmet demand, and that's going to continue to act as a pressure on rents for best-in-class space. But there isn't just a phenomenon for the office sector. Logistics occupiers are also setting ambitious net zero carbon targets. For example, Amazon and DPD both aim to be operationally net zero carbon by 2040, and the parcel delivery operator Every has set a target of 2035. You can see from this chart on the right that in 2023, 90% of major logistics operators have set a net zero carbon target, and that's up from 78% in 2022. So this is something that's moving quite rapidly. In a sector that's very cost sensitive, if buildings can also offer cheap energy through solar panels or the roof or heat pumps, then that's a further benefit to their operations as they move from brown buildings to green buildings. So if we move on to the next slide, we've undertaken some analysis to show how delivering energy efficient buildings in the industrial sector can be a win-win situation for both landlords and occupiers. If we compare the occupational costs for a typical brown warehouse with that of a best-in-class asset with considerable capacity to generate clean green energy, you can see that the landlord can charge a rental premium for the green warehouse, while the occupier can still make considerable savings on his total occupancy cost from the significantly reduced energy costs. A survey by CBRE found that 75% of logistics occupiers would be willing to pay a rental premium to switch to green energy. So, to sum up, there's compelling evidence that the combination of repricing, of occupiers' ambitious net zero carbon targets, and therefore their demand for green space, and the supply and demand imbalance for sustainable real estate provides an attractive entry point for brown to green strategies in 2024. I'm going to hand over to Emmerich now to explain how pursuing impact-focused renovation makes sense from an investment perspective. Over to you, Emmerich.
Thank you, Kim. Thank you very much. So what I would like to explore now with you carefully is how selected impact investment can and will generate enhanced return to investors when it comes to value-add strategies. So just to put things in context, I would like here to remind what we mean here by value-add strategies. We contemplate here to buy existing properties, vacant or about to be vacated. We improve them through a series of refurbishments, capital expenditure. We then relet them, and then we dispose of them. All of that in an accelerated time frame of 3 to 5 years. So let me take you through that rather complicated slide, We try here to compare 3 possible value-add strategies. The first one on the left-hand side is the traditional value-add strategies, which we all know about for many, many years. We call it here, for the purpose of the presentation, a standard renovation. The second one in the middle, which emerged in the last 5 to 7 years, I would say, is a strategy trying to enhance the ESG characteristics of a property. So here we call it ESG renovation. And finally, the last one on the right-hand side is the one we deploy more specifically at Fidelity, where we go one step further on ESG as we aim to deliver impact. So we call it impact-focused renovation. Those numbers are based on a true existing opportunity, an office building located in one of the major financial districts in Europe, so a truly prime location. However, you will see, depending upon the value-add strategy deployed, we see some clear differences on the outcome. First of all, on the entry, when it comes to purchasing of the assets, obviously the market price is the market price, whatever the strategy deployed behind is. Therefore, The entry price stays the same for those three scenarios. Then when it comes to the CapEx injection into the property, an ESG renovation, accordingly to academic research, suggests that ESG CapEx renovation are more expensive and more costly than a non-ESG renovation. The difference being, on average, an additional 30% on the budget. At Fidelity, we go one step further. We deploy CapEx for impact, so we spend a further 20% or more on CapEx. The impact CapEx we are deploying are along the line of bringing the building to net zero carbon capability, adding renewable energy production on site, improving massively the energy efficiency of the building, replacing all of mechanical equipment, adding air heating pump, improving insulation, but also we look at reducing the use of the water on site through, for example, installing rain harvesting system. We are also removing any source of energy which could emit CO2 on site. With those CapEx, they are more costly and often more lengthy, but they also bring benefits. So, on the benefit side, the rental value of the assets, accordingly again to academic studies, those academic studies are showing that ESG buildings are attracting on average a 6% rental premium. At Fidelity, with our impact strategy, we are able to push that percentage beyond 10%. Also, when it comes to financing, we are able to secure better and more favorable loan terms. Why? Because our impact strategy is fully aligned and even goes far beyond the requirement from the banks when it comes to their own green loan framework. Then, very importantly, when looking at the disposal value of those assets, after renovation and after reletting, our impact strategy is also enabling us to attract a premium on the exit price. Why? Because we are bringing already those assets in line with 2050 targets of the Paris Climate Agreement, meaning that the asset is not running the risk anymore of being stranded for at least the next 25 years. Core investors have a clear preference toward buying green assets, and they are ready to pay even a premium if the building have a net zero carbon capability on top. When combining all of those advantages on the rent, on the financing, on the exit value, we are able to generate enhanced returns. And as you can see on the screen, for that specific asset, we are currently anticipating in returns in the range of 15 to 18% growth. Also, on top of those benefits highlighted here, what we are not showing in the numbers is the fact that by doing the right impact investment, we are increasing further the liquidity as well of those assets, both on the letting and on the investment market. It means that impact investment is also bringing an acceleration of the implementation of the business plan for the assets, which translates then into being able to let and dispose quicker of those assets. This acceleration also pushes the returns. In summary then, the analysis is proving that by increasing appropriately the CapEx to hit the impact targets, that will be beneficial to the rental value we can achieve, to the cost of the financing, and to the disposal price, leading then to a better returns. On top, it shall de-risk further somewhat the asset as it will increase its liquidity. Then, if we move please to the next slide, here is one of our recent acquisitions for one of our impact strategy funds. This asset is a modern office building located in the city of London, located 100 meters away only from St. Paul Cathedral and 1 meter away roughly from the Thames River. The asset was purchased at a significant discount price, and we use for its acquisition a green mortgage loan, secured with a major UK bank. We are very excited and convinced that we will be able to deliver with that asset a highly modern office building, energy efficient, and net zero carbon capable. We are going to deploy a number of impact investments on top of the usual renovation, such as after renovation, the building will be so much energy efficient that we would have improved its energy efficiency by 75%. The energy performance certificate of the building will be A, so equivalent to a brand new building. The building will be capable of being operated at net zero carbon. The BREEAM certification of the asset will be at least excellent, but we are already contemplating to reach outstanding, so again, comparable to a brand new building. The asset will offer very attractive amenities, such as, for example, a terrace on the roof overlooking most of the city of London. The viewing by potential occupiers have already started, while the asset is not expected to be ready before second half of 2025. As of today, and based on rather conservative assumption, and importantly, not factoring any green premium on the rent or on the price yet at this stage, we are already anticipating comfortably a return in excess of 12%. If any kind of green premium was to materialize either on the rent or on the disposal price, as we are convinced, then the return will be significantly enhanced. And that is it for my part. On that, I would like to pass over to Nina to conclude now, please.
Thank you, Eric. It was a really interesting presentation. I would ask people if they'd like to submit questions, please use the button at the bottom of the page. But if I can just quickly summarize what we've heard so far today, because we're undertaking this broader shift towards net zero carbon, and because of the lack of suitable buildings in Europe, there's a real mismatch at the moment between supply and demand, and that is creating a really strong green premium in the market. And market conditions being what they are today, there's a real window of opportunity for value-add investors to secure these assets at pretty attractive pricing and be able to capture that green premium. Well, following a comprehensive impact approach is not just the right thing to do for the planet, but it also allows for a more lucrative return profile too. So managers that follow an impact refurbishment value-add approach are better positioned to deliver attractive returns for investors. So moving on to questions now, and I hope it's okay if I can kick off with one of mine, if I can come to you, Kim. Looking at the data at the beginning and looking at valuations and things, especially the offices, given the shift that we're seeing to hybrid working in the wake of the pandemic, how concerned are you about the outlook for valuations? Sorry, Kim, you just have to unmute yourself. This is how bad we are for our shift to hybrid working.
I think to be honest, I think we will see a little bit more of a drift down in office values this year. But what we're definitely seeing is this premium for green offices. There's a real shortage of that space. And in Europe as a whole, vacancy rates are very, very low. We're seeing occupiers who want to secure the right quality space in the right location having to take pre-lets at least 3 years out to secure space if they want to, if they've got particularly strong vision. So what we're clearly seeing now is companies starting to make planning decisions about their space so that they can secure what they need, and they're willing to pay a significant premium for it. So I think there'll be secondary offices that perform very badly, that aren't easily convertible and are in unattractive locations, which will probably go for alternative usage in the end, and will continue to see value declines. But for good quality space in core locations, I think that we'll see a strong uplift in valuations as we see some of these deals come through over the next year or two.
When you're talking about core locations or unattractive locations, today the data has really been looking across markets as a whole. In a couple of those charts, there were some differences between different countries, different markets in different countries. What sort of divergences are you seeing within Europe, and which areas are more attractive right now?
The divergence that we've seen in those valuation falls have been much more about where yields were 18 months ago. So the very lowest yielding markets have seen the biggest repricing, simply as a sort of mathematical exercise, from going from a yield of 3% out to a yield of 4% is a much bigger impact than moving from a yield of 4% to a yield of 5%. So it's much more about interest rates and the pressure that's been put on pricing rather than the attractiveness of the markets. If you look at the occupier side of things, rents have continued to grow in nearly all major markets in Europe. And the things that people are looking for are good public transport connections, easily accessible locations, amenity-rich locations, so that when people travel to work, it's for other reasons as well. It makes that journey to work rather than sitting at home worthwhile.
Thank you. Emeric, can I come to you now? Whenever there's any discussion about sustainability, that terrible word greenwashing raises its head. And when we're talking about an impact renovation, what sorts of KPIs are we tracking to ensure that we're on the right course? How do we ensure that we're maximizing impact?
Yeah, that's always a big question. So, at Fidelity, it took us the best of 3 years almost to come up with a very detailed, comprehensive impact framework. So, because indeed, we are very much afraid of being accused of any kind of greenwashing. So what we have done, we have come up with something like 21 KPIs in total, which we are tracking very thoroughly. And the aim of all of that is to be extremely transparent in our reporting to clients, to investors, to board members, etc., and also obviously to the regulator. So our funds are aligned with the EU taxonomy, so that's a first point, which is extremely important for us. We are also aligning ourselves to the SFDR regulation. We are aligning ourselves to the UN SDG goals. And all of that is done in a way that we are tracking each and every renovation we do. We are tracking and measuring everything we do, and we are reporting on that on an extremely regular basis, on a fully transparent basis, to make sure that everything we do is documented and we can prove that the impact measure we are implementing are truly realized at the end of the journey.
And there's some third-party consultants and things coming in as well to make sure we're on track and that we're reporting it in the right way.
Yeah, you're right. Exactly. We've got as well. This is not only us tracking things. Obviously, there are external parties auditing what we are doing and documenting what we are doing as well. And those reports are fully available to our investors.
Right. Thank you. Kim, we've had a question come in looking at different types of retrofitting. Emeric's discussion today was more about offices, but what different considerations do we have to make for logistics or other, for warehouses or other logistics assets?
So I think the amazing thing about looking at logistics is just how much you can do with a logistics shed. So the easiest point is to put solar panels on the roofs, or because you've got a large land area, you can also use ground source heat pumps or air source heat pumps. You forget that most warehouses have a big office component as well, so that can be moved to net zero carbon by removing gas and obviously using a lot of that energy from either solar panels or heat pumps to refit it. And then there's a lot of work that can be done on insulation in the area around. You've got a lot of initiatives you can take on wildlife and providing green areas. You can still provide that quality of workplace for the staff as well, in creating outside areas for breaks, etc. So it's actually remarkable how much you can do, but very much focused on that provision of green energy. And that really resonates with occupiers, as we showed in that slide, that the amount of savings they can make on their energy consumption from the green energy that can be delivered by the site makes a huge difference to their operational costs.
Thank you. Emeric, we've illustrated that an impact-focused renovation is more expensive than a standard retrofit or even than ESG retrofits. But what other risks should we be thinking about for this process?
Yes, the main other risk, if you want, is the length of those capex, because we are adding complexity to those capex, and that means that we are adding on the length of it and on the complexity of those capex. So it means that in order to control that risk, what we have chosen to do at Fidelity, we have a very thorough and a team which is of asset managers across the continent, which are very close to the asset, and they are extremely well trained. Their use of those capex more and more, they are trained on all kind of ESG matters, obviously. Their use of following those kind of capex. And on top of that, what we have done is we have carefully selected a number of partners, project managers, builders, architects, etc., the sustainable specialists, which are accompany us on the journey when it comes to renovating a building. So we have inside and outside consultants, which are extremely well trained on the matter, which means a bit more cost, but I think it is money well spent in order to control that risk of the length and the complexity of those capex.
Thank you. And Kim, if I can just come to you for one final one. We talked a little bit about how these assets are going to be future-proofed. But what extent can we really take that to? Sort of how prepared can we be for regulation that may come in 5 or even 10 years down the line? What sort of preparation can we do for that sort of thing?
I think that this focus on net zero carbon is really important, and making sure that the buildings are operational at net zero carbon, because that should give you a large future proofing. And what we have seen that regulation is very effective in driving behaviours both of occupiers and of owners and developers. So as an example, both in the UK and the Netherlands, there has been proposed regulation to limit the ability to lease buildings if they don't meet the most energy efficient standards. Clearly, if you're developing a building that's going to meet net zero carbon expectations and be operationally net zero carbon, you should be able to comfortably meet that sort of regulatory introduction. So I think if you make sure that you're reporting clearly, that you're meeting those sort of big 2050 targets of becoming operationally net zero, then I think even as regulation evolves and you start to see governments and organisations becoming more active in sort of pushing behaviours rather than sort of offering the carrot at the moment, your building should still be relatively future-proofed. I don't know if you want to add anything, Emmerich.
No, you're perfectly right. I mean, the net zero carbon is probably the challenge of the next 10 years. And if we are able to accelerate on that, delivering those kind of properties, I mean, that would be a clear win-win from investors and occupiers. I mean, that I'm extremely convinced of. Every day passing by, I mean, I see that as being the main goal of the strategies.
Absolutely. Oh, thank you, Emmerich, and thank you, Kim. That's actually bringing us up towards the end of the time that we have today. If you would like to find out more, if you have any additional questions, please reach out to your local Fidelity contact and we will be happy to help. We'd also appreciate any feedback you have about this webinar. So please do get in touch with them if you have any comments as well. And we will be sending out recordings of this webinar after the call. Thank you so much for joining us today. Goodbye.